I'm Roy Zimmerhansl. I'm your host today for another Securities Lending Saturday. Today's topic, we're going to be talking about how to lift securities lending returns for lending investors. So if you are part of the securities lending ecosystem, if you're a lender, a borrower, or you're just plain old interested, then this is the place for you. So now that we've got the sound back, let's get started. Hi, everyone. Welcome to another Securities Lending Saturday. But today, the sun is shining, so it's made my lighting a little bit easier. Than I hope you're having a great day. Today, as I said, we're going to be talking about how to lift securities lending revenues or returns for investors. And again, this idea was suggested by one of our viewers. Amel, you know who you are. Yeah, I think you should become my producer because you keep suggesting ideas that are great topics for discussion here. So, as usual, I've got my slide. I will get that up in just a second and we'll get started with it. So, hello, everyone. Listen, thanks very much for joining. Greg, great to see you. Thanks for your comments. I'm glad the sound is back. I tell you, listen, this week I am going to post on LinkedIn that what I really need help with is a real producer, someone looking for work experience, because I don't get paid for these videos. I do them because I love all of you and I love securities lending. But if you know anyone that is interested in getting some practical experience producing a show like this, I'm actually not kidding. I am looking for someone to help me out with that and hopefully smooth out some of these bumps I'm not technically incompetent. I want you all to know that, but I just can't seem to get this correct week in and week out. But anyways, let's get to it. How are we going to lift securities lending returns for investors? This is what we've been talking about for the last 34 weeks. Full range of topics. Last week it was bilateral versus tri-party collateral. This week, increasing income for customers. And next week, we're going to take a quick snapshot of the fourth quarter revenues for individual firms as well as the market overall. So there's been, I think it's always worth just examining how different firms do, because different parts of the market can over or underperform at different times, as well as just the overall market itself. So what we're going to be talking about today is really mining for extra revenues for securities lending. So we're going to talk about a bunch of things. We aren't necessarily going to be talking about everything in depth because I've covered many of these topics before. So I'll refer you to other videos. For those of you who are watching on link, this will be continue to be live. So if you want to stay on the live show, you'll see the full show. But if you're watching it on replay, you're only going to see the first 10 minutes. And in fact, I'll move the first 2 minutes of that as well, because it was just in silence. So maybe the first 12 minutes will be there. We'll do some editing overnight, and then it'll be available on the YouTube channel from tomorrow at 3 p.m. UK time. That's the channel there where you can find this and every other video that I've done. I think we're well over 100 now over the past 18 months. And don't forget as well, if you want to order slides from this show and previous ones, just go there, sign up, and over the coming days, we'll send it out to you. Okay, that's what the plan is. Let's get back to, let me get rid of that so you can see it. We're going to talk about whether you should lend at all. Look at what's available for loan and what the impact is and where some of the pitfalls come, because accidents happen, things get missed, and that particularly is an area that gets overlooked quite often. So we're going to take a big look at that. We'll look at agent constraints and the kinds of impact that it can have on revenue in terms of which service provider or providers you choose to use. We're going to look at some of the borrower issues, things that they raise and their own concerns and limitations. We'll look at collateral, because obviously that's one of the most direct drivers of the actual returns that you can make and your opportunities that you get in the first place. But we need to do all of this in terms of a framework of risk awareness. So you can't just say, I'm going to go chase more money without understanding what that does to the risk dynamics of what you are looking at. And then finally, we just wrap up with governance, because the reality is any changes you make to the program, you really have to understand that in the holistic sense and good governance wrapping around this. Okay. So that's the plan. As I said, we've got over 100 videos out there now on the YouTube channel. If this video is helpful to you, please give us a thumbs up or a like on whichever platform that you're on right now. If you want to make certain that you get every video after this, subscribe and ring the bell. There we go. Okay. Those of you who've been watching me for a little while know that my goal right now is to get to 500 views, because as soon as I have 500 subscribers on YouTube, they open up the community channel and there'll be more questions. I've had several questions this week from people. Kim, if you are out there, I will get to your questions probably tomorrow, and I'll get back to you then. But I really appreciate people putting questions in. But if we get to 5, it opens up the community channel and we'll have even more opportunity for engagement there. And that's what I'm really looking forward to. We've had a great week for subscriptions. So every one of you there that subscribed in the past week, thanks. Everyone else that watched it and shared it with other people, because I know that happened, thanks very much. I think we added over 20 subscribe over the past week. That's probably my best week ever. Remember, I'm just a little niche on YouTube, but I'm super excited about 20 people. That's amazing. If we get another 20 3 weeks in a row, we'll probably get over 500. So the goal is 500 in February. All right, that's the new catchphrase. Now, the one thing that I still don't understand is why I'm not sponsored by Coca-Cola yet. Just doesn't make any sense to me. Because I said, I'm not really going to talk about whether you should lend or not, because in fact, I've done 2 videos on that. One is this one that I'm showing here about why people should lend. That was part 31. I'll put a link in the description and you'll be able to go straight to that video. And then we also did one a couple of weeks ago, which is why most investors still don't lend. And I'll put a link into that as well. So if you want to look at the why lend and why people don't lend, those are good videos to go through. But really, the idea here is it's a question of revenue versus risk, right? The safest pathway, of course, is to not lend. And therefore, you don't expose yourself to the small but incremental risk that engaging in a lending program brings to an investor. But of course, what you also don't get is you don't get the revenues for that. And securities lending, as I keep saying, is relatively low revenue for very low risk, in my opinion. But the more important thing is it's the cumulative positive impact year after year. And most of the investors that are big players in this business are really about long-term cumulative returns. And so it's critically important for that sector. So revenue versus risk, and then tempered by ethics. And what I mean by ethics is, on the one hand, you have those investors who believe that short selling and securities lending feeding short selling is a bad thing. On the other hand, you have institutional investors who believe that part of their objective, their altruistic element of being in a lending program, is to add liquidity to the market, to make their securities available for loan. And we see that with large institutional investors. We also saw it with central banks, where they became big buyers of bonds. And in fact, they choked off the liquidity of it through the quantitative easing programs that they had, and realized eventually that they needed to become market participants like everyone else. So there is an element of operational market efficiency that I think is an obligation for investors to at least consider. So revenue, what's my upside from participation? What's the risk of participation? And then what's my view on the business activity itself? Is it good for markets, as most regulators and other observers believe, or is it unethical and immoral, as a small community, but an important community of investors also believe? I can't tell you what the right thing is. That's up to you. So to lend or not to lend, that is the question, but not one that I can actually answer for you. Now, one of the things that is often the easiest way to add revenue is just to see what you actually have available for loan. So imagine I've been in a lending program for 3 months, 6 months, a year, 5 years, 10 years. You can imagine that the program that my agent offered, they might go into new markets. They might go into new asset classes. I, as an investor, might go into new markets or new asset classes. And so, if the program is still structured the way it was 1 year ago, 3 years ago, 5 years ago, I'm probably missing out on revenue opportunities. So, the starting point always is to say, what does my service provider offer and how does that match up against my assets? Now, I would expect that a good service provider is doing that check for you anyway, and hopefully is discussing that at least with annually with you, and also making you up to bringing you up to date when they add new assets into the program. And so one of the things that often falls out of people's checklists is ETFs, because in some programs where you'll actually see assets are actually classified organizationally, ETFs often look like they're mutual funds. And often in lending programs, funds are disabled from lending. So that's just a quick tip. If you have ETFs in your portfolio, ask your agent lender whether those are also made available for loan. And if they say yes, and you're not seeing any revenue from that, you should ask why, because there is quite a lot of demand to borrow ETFs. Obviously, not every ETF, just like there isn't demand to borrow every stock or bond, but really dig down in there. So that's a top tip. Before I go to another slide, Joseph, thanks very much for joining. Yeah, look, as Joseph says, ethics is a question of perception, regardless of one's view. Yeah, always. Yeah, ethics are individual, which is why I said I can't really tell you whether it's the right thing or not. It has to satisfy whatever your criteria of doing something good or doing something bad is. So thanks for pointing that out. And thanks for joining, Joseph. So what's available for loan? Check what you have authorized, check what you don't want authorized. So I've seen investors who often will say, they don't want maybe their small cap portfolios to be loaned out because they're worried that the liquidity in small caps is less than it is in mid caps and large caps, obviously, almost by definition. So the reality is they may take a different view. So they may say, look, I'm okay with this portfolio, that portfolio, this asset class, that asset class. However, I want to ring fence and exclude this. Of course, that's the right of every lender in a program to do that. And also on individual stocks, you can say, I don't want this stock ever to be loaned out. From time to time, if events happen, you may want to exclude an asset that you would normally be happy to lend, but not this time. A question again from Joseph: what proportion of lending volume comes from ETFs? And raising the question of surely the revenue from lending subsidizes most of the free fees. So yes, absolutely. ETFs. One of the main reasons that ETFs lend is to either reduce their cost of operation, their total operating expenses, or total expense ratio, they all have different names for it, or to generate incremental performance to either get closer to the index or in some cases surpass the index, really to differentiate on a performance level. So clearly ETFs are an important asset class. I don't think that I have any statistics as to how much of the lending business is driven by ETFs. I think I can probably find it. We got a lot of good data providers that support the program. But look, what I will tell you is that lending ETFs in the US is much more commonplace than it is in Europe. Some of that is breadth of investors that are involved in lending programs. Some of it is there are operating challenges in Europe because often you'll see the same ETF listed on multiple exchanges. And in the absence of a consolidated tape, there's no real good way to track total volumes. And most firms have limitations based on turnover in terms of lending and taking things as collateral. So having a split tape where it trades partly in Frankfurt, partly in London, partly in Milan or Paris, that throws up a real challenge in terms of monitoring the true liquidity of that. Now, for those of you that don't know, I co-authored a white paper almost 10 years ago now on European ETFs and secondary market liquidity, and we made 4 recommendations on how to make the European ETF market more liquid. It's still pretty much as relevant today as it was then. And again, what I'll do is I'll put that in the show notes. And if you're interested in looking at that white paper, I'd love for you to do that. ETFs, big ETFs, obviously in Asia, they also have an impact and generate revenue in Asia. The things like the Chinese indices have often been very much in demand. So there is global revenues there, but everything's relative in terms of scale. But ETFs, I keep saying, will continue to grow and become more important. Okay, so that's what's available for. Let's go now to agent constraints, because of course, whoever you use as a service provider has their own program and their own focus and their own direction and their own criteria, because they're the ones operating the program. As an investor, if I want my agent to deal with a particular counterparty who's not approved, well, unlucky for me. They may consider adding them, but there is their own risk parameters that they need to go through. So I've identified 4 here. One is the list of borrowers. So does the agent have a full range of borrowers that actually match against the assets that you have? Because you'll find often that firms have a particular axe in their own home market. And if you have a portfolio that has big allocations to a given market, but there isn't a mixture of international global borrowers and also some firms that have a domestic axe, either with a domestic firm or that there's another access point, maybe they're European or North American offices can access that. But you really want to try and distribute assets to the broadest range of borrowers that there are that you're willing to take the risk on. And as I said before, if I, as an investor, have a wider range of counterparties that I'll deal with than my agent lender, that might be something to talk about. And if it's unsatisfactory, it might be something that you want to explore, maybe adding another agent to that. And the same kind of thing applies to markets, because you'd be surprised at how often there is a variance in terms of the markets that one agent is live in and another agent is live in. And to the extent that a second agent might have a broader range of markets in their program, that should be a revenue opportunity. Now, of course, there may be reasons why your agent isn't in that market. And again, I'd encourage you to explore that with them. They may have valid, important reasons that the other agent might not consider as important. So again, they have their own risk profiles and their own operational infrastructure. Investigate both, determine which applies best for you, and act accordingly. But again, adding a new market is a real critical component of that. And again, here you can see something where, and this has happened to me, look, where we had a client who, when they set up the program, they didn't have assets in a given market, so it wasn't opened up. We added a market subsequently. We dropped the ball, didn't tell them that we'd added the market, and they missed out on opportunity and revenue there. So look, I think it's something that's worth always continually checking. Collateral, of course, with collateral, Joe, I'll come back to that in a second. With collateral, of course, there are preferences. Your agent might have a preference. I, as an investor that's lending, may have a preference. But look, the wider your range of collateral that you accept, the better the opportunity, right? So because there are times when a borrower might not have a lot of equity collateral. So often equity collateral is a great form of collateral. But if at certain points in time, and you can see this throughout the years, as sometimes hedge funds reduce their long exposure to equities, what you actually see is there'll be a shortage of equities. So the equities are being used for collateral transformation trades. So there's not equity. So if that's the only thing you have, then that's a problem. If you also take government bonds, are great, but they can also be expensive. But again, managing the counterparty exposures, what you might sometimes try to do is tie collateral type and market to the market that the loaned assets are. So if I have Australian equities and I'm taking Australian equities or government bonds as collateral, then to an extent, there's an offset there in terms of risk reduction because it's only the relative price movements of those two assets rather than also adding in a currency movement. So you do want to, in a global portfolio, have global collateral if you're dealing with a counterparty that's active in multiple markets. It allows you to offset some of the risk and them to offset some of the risk and therefore be able to do more business. But now we see a market as well, like now, where we have the US dollar, which is likely to see maybe 3 rate rises this year. So all of a sudden, cash reinvestment becomes a lot more attractive than it was 3 months ago, let alone a year ago. So if you are excluding cash at the moment, um, that hasn't really cost you that much. But I suspect that as we get a better interest rate environment, more business will move to cash because it is potentially more profitable or a higher revenue generating option. So the more options you have, the more likely you are to be able to get a loan during all kinds of market conditions. And then the fourth one here is capital. So first of all, we've talked about indemnifications. So indemnifications are really the insurance policy that an agent provides to its client in the event of a counterparty default. And again, if you go back to the risk videos, which I will direct you to in a moment, the type of indemnification provides a different degree of risk coverage. Okay, so a bank line of credit has a completely different profile than a bank that actually puts hard capital reserves behind their indemnification. And then there's other different routes. But first of all, you need to understand what that capital is that's backing any kind of support. But more importantly, uh, because there is a cost to providing indemnifications, it also has an impact on the return targets that an agent might have in order to provide that return or that type of protection and coverage. And so that's one of the reasons why we've seen general collateral or the really widely available blue chip securities be of less interest for many agent lenders to lend because it's expensive to reserve against that. And so they're happy to miss those loans. That might work for them. But what if you're a client where that's your only portfolio? So that's an important consideration that you have to be aware of. And people aren't always aware of that. However, you need to look at as well, that ties into the last point on collateral, where one of the reasons that general collateral has been unattractive, of course, is the cost of the indemnification. But also, if you are doing it against cash collateral, the lack of a reinvestment return opportunity, if that starts to come back, I think that also changes the dynamic in terms of general collateral or GC, as we call it, that an agent lender might be willing and interested to do. Now, so those are the four areas. I'm going to come back to the point on markets, which Joe has asked me to explain a different way because obviously I didn't do it very well the first time. Let me give you a specific example. If you look at a market like I was involved at one of my firms as one of the first lenders of Russian assets. Now, many people said, "Oh, it's an illiquid market. There's no netting opinion. It's too thin." There's all kinds of different reasons why most people weren't in it. And of course, the first time any one firm goes in, well, they're by themselves and they're the first firm to be in that market. But we found ways that we could mitigate the risk on each of those points. The liquidity and the netting opinion had been completed, or the law that was required to recognize offsetting the loan position versus the collateral, because really that was the issue. So we took one view as an agent lender. Another agent lender might take a different view. We said it's riskier than most of the markets we're in, but we think the risk is containable. Whereas the other agents, obviously, by definition, if we were one of the first, the majority of other agents weren't in that market. What's the right answer? I can tell you that none of my clients ever lost money. So the fact that they were earning money when there were Russian assets available to other lenders, but weren't actioned, good for my clients, bad for everybody else. Maybe it could have gone the other way. I don't know. I've never in my career had an experience where we've gone in to a market and been proven as, and look, due diligence and research and analysis standards today are dramatically higher than when I first was involved in opening up new markets. If it passes today's muster, I think that's a pretty good situation. Joseph, I hope that's a little bit more clear, where you can have a given market with two different views from service providers, and there's not necessarily a right one or wrong one. I think I could give you the same example with Thailand, because there are multiple examples of different share classes in Thailand: local, the foreign, and then a third one whose name escapes me at the moment. And again, we were one of the big lenders of that. In fact, I think we were, according to the data that we had, I think we were the biggest lender of that share class type. So again, what we did is we worked very closely with our sub custodian in that market to really find out the true liquidity of it and come up with workarounds or ways to address problems in the event that there was some kind of a crisis. So very much look at individual markets and say, I've got one agent who is or isn't in the market. I see another one who is the opposite. And why is that? What does one know that the other doesn't? And that could be to do it or to not do it, right? I'm not saying all of these are just steam forward. That's the last thing I think anyone should be doing. So that's agent constraints. If that makes sense. Of course, there's also borrowers that have their own limitations, right? Because borrowers, remember, one of the things I keep telling people is lenders, the investors that are lending to the borrowers, are always worried about exposure to borrowers. What if there's another Lehman Brothers? That's true. And that's fundamentally the single most important risk that you face. But what you also have to recall is that the lender only has a potential risk to the borrower if that borrower goes bust and if the collateral proves to be insufficient, right? So there's a lot of and then if they're using an agent program that provides an indemnification, the indemnification must then also fail. So you have 3 layers of protection before a lender is actually at risk for the first penny. Whereas a borrower who's over collateralizing from day one, minute one, always has an ongoing exposure to the underlying lenders. Always. They're always exposed, real money exposed. And of course, there is no indemnification for them because they're taking the position. So borrowers, of course, have credit limits for clients. That's also a problem for new investors that come into programs because it takes a while for credit limits to be put in place. It also will be prioritized. So if you're a small fund, it may take a while for you to get approved by borrowers just as they go through their priorities. Borrowers will also choose collateral types that work for them for either given transactions or as an overall standard. They prefer to deal with this kind of collateral as opposed to that. Of course, they're going to differentiate based on withholding taxes. Remember, from a borrower's point of view, the higher the withholding, the more interesting it is, because in the event it goes over a dividend date, the amount of substitute income that they have to pay is reduced. So they're always looking for investors that suffer a lot of withholding taxes. Netting opinions and the jurisdictions of the investors, that's a critical one, because if there's no clean netting opinion, effectively they're having to put up capital reserves of up to 100% for the position. And then there's a growing amount of pledge activity going on as well, where a borrower will direct business to a lender that takes pledge collateral as opposed to transfer of title. So all of those are kind of structural framework things that describe borrower limitations. On an operating basis, of course, a day-to-day activity, borrowers may prefer those that exercise or execute trades in an automated fashion, either via platform like Equilend, NGT, or LoanNet, and bilateral arrangements, right? There's quite a lot of automation that happens and can happen between firms. And so again, trades may be directed to those firms that can execute trades quickly and efficient. Borrowers are also going to have a little bit of a bias, maybe in terms of their stability of the lending supply from a given lender. They may choose to not want to borrow from one if it turns out that the lender recalls them too often, either because they're selling because they turn over the portfolio too quickly, or in the event that an investor is a very aggressive voter and the borrower would just rather not deal with that. So there are exceptions there, but that's transactional based. And then, of course, efficiency. And I've got a little asterisk there because I don't really think there's a lot of differentiation today with a borrower looking at their universe of lenders and saying, I really don't want to trade with those guys because they fail trades or they're late with payments or, whatever it is. They don't really do that much. However, I think that will become an ever more critical component over time. So keep an eye on that. Now, another question from Joseph. It must be interesting to see how this plays out in coal or oil drillers today, where some take the view that providing liquidity is not a good thing versus others taking the view that shorting them is a good thing, even when both agree coal and upstream fossil fuels are bad. And that's a really timely and important question. That's really at the heart of ESG and the questions around that. And I think this is going to play out and it will continue to grow this year. It's one of the reasons why I'm particularly involved with the Global Principles for Sustainable Securities Lending, because it's about helping people think about exactly that kind of point. So you could take a couple of different approaches. One would be fossil fuels are bad. Don't mind if people want to borrow the fossil fuels in my portfolio and short them with a view of driving the prices down. That's certainly one way of doing it. There are people, of course, who say, I have stuff in my portfolio because I own an index. I'm an index tracker, so I don't have any choice except to own fossil fuel providers. So any money that I make is extra money because I can't not have it in my portfolio, because if I don't have an index component in my portfolio, I'm now at a disadvantage to any of my peer group that has fewer concerns than I do. So there is that kind of element to it. There are actually investors as well that I've met who say, I won't lend out my fossil fuel portfolio, and I also won't use a hedge fund that shorts that kind of a market because I don't want to make any kind of money in any way from that whole community. I want to stay away from all of that. So that's a historic negative approach to it. I won't do it because of the category. Then there's the more progressive view that says, look, there might be two fossil fuel legacy companies, one that's trying to make a greener transition or do it faster or do it wider or whatever, compared to the other one. And wouldn't it be better if I would take the collateral from one of them, the one that's trying to make the change, because to me, that's a better quality asset than the one that's just fossil fuel stuck in that. Maybe I won't take that as collateral. And that kind of reduced liquidity in that security, maybe that will have a tiny bit of influence in terms of the company's forward direction. I think we'll see that play out with repo as well, increasingly in years to come. But yeah, another super question. You win the prize today for best questions, Joseph. So thank you. We talked about collateral. I think I've covered it off. These are the two videos that I've already done on collateral. So if you want to learn about the two different models and how the collateral affects the fees, the types, the constraints, and more about cash and non-cash, go to those videos. I'll put links in the descriptions or in this video when it gets edited. So look at it there. As I said earlier, wider collateral range equals more opportunities. If you have the broadest range of collateral, you'll get the most opportunities for loan. Cash collateral, particularly US dollars, because of the rate changes that are pending, I think that shows a great opportunity going forward. But of course, remember, change your collateral and it changes your risk. Maybe for the better, maybe not for the better, or maybe it's uncertain. But before you make a change to your collateral, be aware of what the impact will be in stress times. And there isn't one such example that there's just a stress time. And so you can test against that. 20 plus years ago, I wrote an article after the demise of a Hong Kong-based broker where I showed three different scenarios where having equity collateral was great or bad, having a government bond collateral was great or bad, and having cash collateral was great or bad. So there is no one right answer. It's you need to understand what can happen in different scenarios. There are most often outcomes, there's no question, but there is no one hard fast answer. Another question, do you have a feel for the amount to borrow from non-hedge fund short sellers? First of all, you have to say, what do you describe as a hedge fund? So Archegos, as an example, they went long positions, but they also over time had short positions. But they aren't technically a hedge fund, even though people were describing them as. They were a family office. Whether they were acting like a hedge fund or not is a different question. But so do you include those firms? Do you include high frequency trading firms as hedge funds? Probably not. And if you look at all of the arbitrage firms like the options market makers, again, those are not hedge funds. So I think it's difficult to come up with figures in that. I think broadly, you can look at trading strategies and you can guess that there are hedge funds behind some of those activities and not. So the more frequent, the more high turnover that there is, the more likely it is to encompass a wider group of participants. And of course, retail investors, there are a broad range of those, and that's growing. Non-short sellers. I'm not really certain what you mean by non-short sellers. So maybe if you can explain that, or maybe drop me an email, and if it's something that I think would be of interest to the wider community, I will share that out. Any questions for me? Just Kim did. If you're watching, Kim, she sent me a question at my email address, roy@pierpoint.info. Please don't hesitate to do that. And I'm always looking to answer a question. Yeah, again, Joseph, I'm not certain that there's data on that because I don't think it gets categorized by the end. The data that we have available in the market really is the intermediary market. It's from the borrower who's borrowing it from an agent intermediary, and then the agent intermediary, they will often, but not always, identify the type of category of their underlying clients. They do that so that the data providers like Aztec Analytics from FIS or DataLend or IHS Market, the reason the agents identify it is so that their underlying clients can be categorized with their peer group and provide relevant data. The beneficial owners, the prime brokers don't really categorize that data for their underlying clients. It's not really reported. So there isn't any real information. Okay. So yeah, as far as aggressive voters, well, you do have, of course, the activist short sellers who are an important community. They're the ones that really try to call out fraudulent companies. They're the ones that I think are really in the vanguard of making certain that everyone stays on top. Greenwashing, right? Who else is going to be looking after greenwashing other than activist short sellers that call companies that say things, look at this green or sustainable policy that we have, and don't really follow through on it. It's more sort of a marketing exercise. So activist short sellers, of course, are very interested in influencing the companies. On the other hand, you have beneficial owners who, in many cases, particularly in the US with the SEC, they're under increasing pressure to vote more actively. Now, I think there's always a fine line to walk between generating a return for your stakeholder if you're a fund manager versus your corporate governance obligations. And so it's a challenging line, and one that I'm glad that I don't have to decide what the right thing to do is. But look, make no, you don't doubt this at all. There will be more voting going forward than there has been historically, without a shadow of a doubt. All right. So we need, as a market, to be able to be aware of that and cope with it effectively. So that's collateral. Risk awareness is a little bit of a cocktail glass of things. Again, there's the two videos on risk, which I'll put links into, but really the risk awareness really follows on from what I was talking about before. It's really that choice about the counterparty selection, the collateral that you use, and the indemnification. So change anything, and you have to re-examine how that cocktail mix works for you and whether it's still appropriate. Okay. So look at those videos. You'll learn more about securities lending risk and the 6 different risks and the risk mitigants. Okay. And then finally, really just the governance really needs to look at all of those points that we've talked about today, but specifically codifying it, identifying it in terms of a coherent policy that covers everything about what they do. Why do you lend? How do you determine which assets are available for loan? How do you determine your agent provider or providers? And what's your test of their ongoing performance? How do you choose your borrowers, who to deal with, who not to deal with? What kind of collateral and why does that fit with what you're doing? And really, all of that needs to be wrapped in a risk governance profile that actually says, look, these are what the risks are. This is what our returns are expected to be, or how we expect to generate the returns. And this is why we think it's an acceptable risk for our firm or our fund or our investors or our stakeholders. And of course, in addition to all those, there's also the ESG, which again, Joseph, thanks very much for mentioning that, because that was a great lead into today, into this slide. And again, I have 2 videos on that, which you can feel free to go back to and just look that up. So all of the activity we talked about, add ESG into that and put it into a package and say, this is how we do securities lending. And yes, it's a pain in the butt, I'm sure, for many people, but I can't believe that someone would be in a business that generates incremental risk, generates revenue, and wouldn't want to have this kind of a package showing what, how, and why. Okay, that's it. I obviously haven't updated that slide. There you go. So I tell you what we're going to do. We will go back and I will summarize on this page. A bit of magic. We're back at the summary page now. Look, to lend or not to lend, that's an individual choice that should be driven by the ethics, but then everything follows from that. What's available for loan? It's a constantly changing environment for both the investor and the service providers. Be aware of the agent constraints and what impact that has in your ability to generate more income. Be aware of how borrowers view lenders. And I think there are also corporate relationships, which I'm often surprised that more institutional investors that lend don't try to leverage any of their commission or fee generation relationship with underlying borrowers to generate more activity. So you can do, there's nothing stopping you from doing that. Collateral fundamentally is one of the most important factors in determining how much money you can make. Too narrow and you'll miss a lot of opportunities. Too broad and you might be taking on unnecessary risk, but you'll also likely to be generating the most revenue. Risk awareness, don't do anything before you understand the risk. And of course, governance, you need to be able to step back and say, this is what we do, how we do it, and why we do it. All right. So that's the summary of what we talked about today. I will put that in properly in the final version of it. And next week, since we're talking about money anyway, I'm going to talk about a review of Q4 revenue and maybe full year 2021. I don't know. I need to see what information is available out there. But certainly, I'm going to be talking about some of the firms, because I saw a great post on LinkedIn today from Boaz Yari from ShareGain, highlighting what's happening at some of the brokerage firms. I think that's worth revisiting, and I'll address that next week. And yeah, good. Joseph, maybe we should just have a connection anyway. It'd be good to talk to you. Some great questions today, and I'm quite interested in that. All right, so look, that's it for me. It's a little bit longer than normal today, but mostly because of great questions. Thanks very much. I really appreciate that. Help me get to 500 subscribers so that we can open up the community channel, and a lot of these questions can be discussed in more detail. I look forward to that. Have a great Saturday. Have a great weekend. Have a great week, and I look forward to catching you next time. Thanks and goodbye.